You're watching your portfolio bleed red. Silver just collapsed to 74.64, down over 4% in hours. The panic is spreading through every retail forum you follow. But if you're selling right now, you're being played, and you're about to miss the most violent legal exploit in modern American trade history. Stop staring at New York. Look at Shanghai. While New York dumps silver at $74, the Shanghai Gold Exchange is paying $82.11. This morning it hit $86. That's an $8 spread. This isn't a market inefficiency. This is a systemic fracture. The Western paper system is collapsing in real time. Physical metal is hemorrhaging from west to east faster than any period since the Nixon shock. And the reason isn't on any chart you're watching. It's buried in the Federal Register. Executive Order 14346, Annex 2 modifications. While the media obsesses over EV tariffs and semiconductor restrictions, they ignored page 7. This executive order is the detonator. And if you don't understand what Annex 2 does to silver's supply chain, you're going to liquidate your position at the exact moment you should be loading the boat. This is not analysis. This is a 4-part exposure. We're dissecting the silver squeeze of 2026. We're showing you why the Trump administration opened a bullion backdoor while sealing every other import route. We're walking through the China export lockdown that went live January 1st. And we're proving why this $74 crash is the final margin purge before the supply vacuum detonates. Here's the document. When the president invoked the Reciprocal Trade Act under the International Emergency Economic Powers Act, he dropped 10 to 100% tariffs on nearly every product entering America. Steel, aluminum, electronics, solar panels. If it crosses the border from China, Mexico, or Europe, it gets taxed. This was designed to cripple foreign manufacturing. But there was a structural flaw, a catastrophic one. The United States doesn't produce silver. We burn through thousands of tons for missiles, solar arrays, and medical equipment. But we mine virtually nothing. If the president had taxed raw silver, American industry would have flatlined overnight. So they carved out Annex 2. Legal text reads, "Goods added to Annex 2 shall no longer be subject to reciprocal tariffs. These goods include bullion-related articles. Code 71069-1110. Silver bullion. Tariff-free." Do you understand what this creates? The most violent incentive structure in economic history. Import a finished solar panel from China? 100% tax. Import the raw silver bar to build that panel in America? 0 tax. This is not an oversight. This is a reshoring black hole. The United States government just weaponized the silver market. They're telling every manufacturer on Earth, relocate your factories here and we'll hand you the metal for free. Stay outside and we'll annihilate your margins. This is why factories are moving. This is why physical demand for silver in North America is about to go parabolic. And China just locked the gate. You need to grasp the timing. January 1st, 2026. 1 week ago, China activated strategic resource export controls. They know exactly what the U.S. is doing. They know the U.S. needs silver to rebuild domestic industry, so they're strangling supply. That $8 Shanghai premium? That's the sound of a vault door slamming. China is paying $86 to trap metal inside their borders. The U.S. is bidding $74. The arbitrage is broken, and when arbitrage breaks, price corrects violently. So why did price drop today? Why are we down 4% if the shortage is this severe? Because the paper market is shaking you out. CME Group raised margin requirements on silver futures yesterday. They made it prohibitively expensive to hold leveraged positions. This forces weak hands to liquidate. It's a liquidity purge. They're hammering price to $74 to trigger your stop losses. But watch who's buying. The physical vaults in Shanghai are draining the West. They're thanking you for the discount. This is the setup. A tariff-free corridor in America creating a demand singularity. An export ban in China building a supply wall. And a paper price that's lying to you about the true value of metal. This is the anomaly. But the real question is what happens when US manufacturing actually ignites? What happens when solar factories in Texas and Ohio scramble for silver that doesn't exist? Next, we're exposing the industrial arbitrage. We're dissecting the solar panic. And we're proving why this specific executive order made silver the only asset on Earth that's not just immune to the trade war, but the primary beneficiary of the inflation it unleashes. The glitch is in the law. The explosion is coming to the market. To understand why silver is coiling like a loaded spring, you need to stop thinking like an investor. Start thinking like a manufacturing CFO. You're the CEO of a major solar company. For 20 years, you built panels in Southeast Asia or China. Labor was cheap. Supply chains were seamless. Then the ground shifted beneath you. Timeline matters. April 2nd, 2025. Executive Order 14257. September 5th, 2025. The hammer. Executive Order 14346. These orders didn't adjust trade policy. They weaponized it. Section 201, massive anti-dumping duties, tariffs on finished solar panels entering the United States, rates in some cases exceeding 50%. January 1st this year, full enforcement kicked in. Your business model just died. You can't sell a panel that costs 50% more than your competitors. Two choices: go bankrupt, or move your factory to the United States. But here's the trap. To build a solar panel, you need silver paste. A lot of it. The photovoltaics industry now consumes nearly 20% of entire annual global silver supply. You relocate your factory to Texas or Ohio to dodge the finished panel tariff. Now you need to source raw silver inside the United States. This is where the math hits the wall. This is the industrial vacuum. The United States is a geological wasteland for silver. We consume massive quantities. We produce almost nothing. Latest U.S. Geological Survey data, the United States mines less than 1,000 metric tons of silver per year. American industry, between electronics, solar, medical devices, devours nearly 8,000 metric tons per year. We produce 1, we consume 8. We're running a 7,000-ton annual deficit. Historically, not a problem. We just imported. But remember the anomaly. The executive orders built a tariff wall around finished goods but left a specific exemption lane for raw bullion. This was the government's desperate attempt to plug that 7,000-ton hole. They're begging the world to flood us with silver to feed the new factories. But the world isn't listening. While Washington signed executive orders in late 2025, the rest of the world started hoarding. Resource nationalism. Mexico, Peru, China. The countries that actually have silver are restricting exports. They want to build their own solar panels, their own missiles. They don't want to ship precious raw materials to America so we can re-industrialize. We have U.S. demand going vertical from forced factory reshoring, global supply contracting from export controls. This creates a biflationary crisis. Learn this term: deflation in profit margins of importers, hyperinflation in raw materials for domestic production. That solar panel, price is skyrocketing. That electric vehicle, cost of goods sold is climbing. Cost push inflation. What's the historical hedge against inflation? Silver. But silver now has dual engines. Investors buying to protect purchasing power from tariff-induced inflation. Industrial giants like Tesla, Samsung, First Solar buying, because if they don't secure physical metal today, their assembly lines stop tomorrow. This is why today's price action at $74 is so deceptive. The paper market is reacting to interest rates and margin calls. Looking at the Federal Reserve, the physical market is looking at warehouse inventory, and the warehouses are empty. COMEX registered inventory, silver actually available for delivery, has plummeted to historic lows. We're operating on fumes. The solar panic specifically. For years, there was a theory manufacturers would just use less silver. They called it thrifting. Replace silver with copper. Print thinner lines. But in 2025, with widespread adoption of TOPCon and HJT solar cells, we hit the physical limit. You cannot remove silver from these high-efficiency panels without destroying performance. At the exact moment EO 14346 forces these factories home, the technology demands more metal than ever. This is the squeeze, not speculation, an industrial accounting error on a national scale. The US government thinks exempting bullion from tariffs will make metal flow. They're wrong. At $74 an ounce, miners can't produce enough to meet this new demand. The Chinese are paying $86 to keep it. Something has to give. Price has to rise to a level that breaks the export bans. We're not talking 80 or 100. We're talking a repricing of the industrial utility of metal itself. But there's another layer, a layer that hits every person with a bank account. The currency. When you have a trade war, you have a currency war. The tariffs are designed to protect the dollar, but they're destroying its purchasing power by making everything more expensive. Next, we're exposing the currency contagion. Why the Federal Reserve is trapped. They can't raise rates to fight tariff inflation because it would obliterate the manufacturing boom they're trying to ignite. And the wealth transfer. How smart money is using this temporary dip to $74 to swap dying dollars for the only asset legally exempt from the chaos. The trap is set. Factories are building, vaults are emptying, price is about to snap. We've covered the supply shock, the industrial vacuum. But there's a third pillar that's more dangerous than the other two combined. Your money. Because Executive Order 14346 didn't just break the silver market, it broke the bond market. And it's about to break the purchasing power of the US dollar. Here's the reality Washington doesn't want you to understand. Tariffs are taxes. When the Reciprocal Trade Act fully implemented in late 2025, the government placed a sales tax on the entire global supply chain. When a U.S. company imports electronics from Asia and pays a 50% tariff, they don't absorb that cost. They pass it to you. Cost push inflation. Right now, January 2026, we're watching the Consumer Price Index spiral. Prices for cars, appliances, building materials ticking up week after week. Normally, the Federal Reserve has a playbook. Inflation goes up, they raise interest rates, tighten money supply to cool the economy. But this time, they can't. This is the Fed trap. The entire goal of the new trade policy is encouraging companies to build factories in America. To build a factory, you need to borrow money, cheap capital. If the Fed raises interest rates to 10% to fight tariff inflation, they crush the manufacturing boom the president is trying to create. They'd bankrupt the solar plants in Texas before concrete is poured. The Fed is checkmated. They have to keep interest rates artificially low to support reindustrialization while watching inflation run hot from tariffs. This is financial repression. Your savings account loses value every month. The dollars in your pocket are being sacrificed to pay for the trade war. This brings us back to the silver exemption. Why did the administration explicitly carve out bullion from the tariff regime? Why create this one lifeboat while sinking everything else? Because they knew. The architects aren't stupid. They understood their trade war would debase the currency. Locking out cheap foreign goods guarantees domestic inflation. So they left the door open for real money to enter the country. The exemption on silver isn't just industrial subsidy. It's tacit admission by the United States government that the dollar is going to lose purchasing power against hard assets. They created a two-tier system. Tier 1, the consumer class. You pay higher prices for everything. You hold paper dollars that buy less every day. Tier 2, the asset class. You own exempted commodities, gold and silver, that reprice higher as currency fails. This is the greatest wealth transfer of our generation. Most people are on the wrong side. They're complaining about egg prices while smart money drains the COMEX. Look at the chart. Gold is trading at 4,135, doing exactly what it's supposed to, sniffing out inflation. But silver at $74 is lagging. Gold to silver ratio currently near 60 to 1. Historically, in times of high inflation and industrial shortages, that ratio collapses to 40 or even 30 to 1. Silver has to almost double just to catch up to where gold is right now, and that assumes gold stands still, which it won't. We're looking at a scenario where the safe haven asset is also the industrial critical asset, the only thing that protects you from inflation and benefits from manufacturing demand, the only asset legally exempt from the trade war causing the inflation in the first place. Do you see the feedback loop? More tariffs, more inflation, more inflation, more investors flee to precious metals. More investors buy silver, harder for industry to find metal. Harder to find metal, higher price goes. Perfect storm. So where does this end? If factories are desperate, Fed is paralyzed, vaults are empty, what's the real price of silver in 2026? We're not talking about $74. That's paper price. We're talking about the price required to pry physical metal from hoarders in Shanghai and Mexico. Final part, we're giving you the price target. The derivative collapse when short sellers realize there's no physical metal to cover bets, and exactly what you need to do before the Shanghai premium becomes global standard. The window is closing. The anomaly is about to correct. Final chapter. We've tracked the anomaly from legal text of Executive Order 1.346 to empty warehouses of solar manufacturers to inflation spiraling in the real economy. Now the final question. The question that defines your portfolio for the next decade. What happens when the paper dam breaks? Right now, silver is 74.64s. But that price is a lie. It's the price of a paper contract on the New York Mercantile Exchange. A promise to deliver silver that doesn't exist. For decades, bullion banks controlled this price by selling naked shorts. Sell millions of paper ounces to suppress price, knowing buyers never ask for metal. They settle in cash. But the executive order changed the game. Buyers are no longer hedge funds looking for cash profit. Buyers are industrial titans. Tesla, First Solar, Samsung, Raytheon. They don't want cash. You can't build a missile with cash. You can't build a solar panel with a wire transfer. They need the physical bar. When they stand for delivery and the vault is empty, the exchange declares force majeure. This is the moment the market disconnects. We're already seeing cracks. That $8 Shanghai premium is the first crack. Physical market already decoupled from paper. Shanghai trading at $86 because that's the real clearing price for physical metal. New York stuck at $74 because banks are desperately trying to cover shorts before default, but they can't hold it forever. Arbitrage is a force of nature. If silver is $12 cheaper in New York than Shanghai, traders buy every ounce in New York and fly it to Shanghai. This drains the West of strategic stockpile. To stop the bleeding, U.S. price must rise to match China. Not a choice. Mathematical necessity. What are the targets? Gold to silver ratio. Gold trading at 4,235. Right now it takes 60 ounces of silver to buy 1 ounce of gold. Historically cheap. In a supply crisis, that ratio compresses. If we return to historic norm of 40-1, silver reprices to $110. Conservative target. But we're not in a normal market. We're in a manufacturing supercycle driven by tariff-exempt bullion. If ratio compresses to 30-1, which we saw in previous bull markets, we're looking at $147 per ounce. If we see a true short squeeze where banks are forced to buy at any price to avoid bankruptcy, price goes vertical. This brings us to final verdict on the silver exemption. The Trump administration didn't write a loophole. They set a trap. They knew exempting silver from tariffs would drive massive demand into a market with no supply. They knew this would break the paper price suppression scheme, and they offered you a golden ticket to opt out of dollar collapse. But you have to act before convergence. Right now, you can still buy physical silver near paper price. You can still get in before New York wakes up to Shanghai reality. But the window is closing. The volatility today, that 4% drop, is the last shakeout. They want your silver. They want you to panic sell so they can cover shorts. Don't give it to them. The executive order is signed. Factories are retooling. Inflation is here. And the price of silver is about to realize its true value. The only question left, will you be holding paper or metal?